And there's a lot of information online. And this podcast is a perfect example of that, where there's information, but it doesn't consider your circumstances. It doesn't consider your goals. It doesn't consider your strategy. And so getting information is great, but receiving personalized advice is what's going to make the biggest impact on your financial journey.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again in cold Melbourne for another 360 Money Matters podcast.
Andrew, it's cold in the morning, which is when we're recording this, but I think today's going to be an absolute ripper of a day. We just went out and grabbed some coffee and the sun is shining.
Don't spend money on a $3 coffee.
Clear blue sky.
Compound interest, $3 a day over the next 30 years. Do what we do. Do what we say, not what we do.
Yes, that's it. Well, I definitely needed it because with one of the podcasts that we started to record before, I didn't have the microphone turned on. So definitely needed it. Just double checking that everything's on. Andrew, we're getting off topic already.
That's what we do best.
What are we talking to everyone about today?
So today we are talking about, you may have heard this before, may not have heard this before, but being asset rich and cash flow poor. Now, this can be either a positive thing, it can be a negative thing, and really we're exploring that topic. We're looking at, okay, if that's your goal or if that's what you want to do, why? Is that a strategy? And if it's not, how do you not get yourself in that position? How do you unwind that position as you start to approach your retirement age?
Yeah, and this is I guess this is a common problem that we see a lot of the time, specifically where it's happened in, I guess, Australia with the way that our property market is derived. So we see a lot of somebody's wealth usually tied up in, I guess, the family home's probably one of the biggest ones that springs to mind from my perspective. And it's great. And, you may have bought the home back in the day for X amount of hundreds of thousands of dollars and now it's worth millions, which is fantastic on paper. But if you're not getting the level of income that you need in order to live the lifestyle that you want, you kind of feel like you're, kind of trapped, I think.
Yeah. And look, I guess it's one of those things that when you're in your wealth accumulation years, being asset rich and cash flow poor is almost the thing that people strive towards, because you're paying tax on your cash flow. So if you're getting income coming in, you're paying tax on that income, whereas an asset that's increasing in value, you're not actually paying any tax until that asset's eventually disposed of and sold, and if there's capital gains implications and whatnot. And so it's a really, or can be a very positive thing in wealth accumulation, but then you start to reach your retirement years or start to approach retirement, and all of a sudden you're wanting to now not rely on the income from your own personal exertion from your employment income. You're wanting to start relying on income from your assets, but you've worked your entire life accumulating assets that aren't generating an income to limit the tax implications. And so all of a sudden there's this awkward position where you're asset rich, but you're cash flow poor. And how do you solve for it?
Well, I guess it really means one of two things, right? And I guess we're talking about this in this point from a retirement perspective, but it means that you have the inability to retire without potentially selling an asset.
Yeah.
Or you've got the level of income that, you could have if you sold assets, but you're not getting those because you're not selling assets.
Yep.
Last week we did an episode on Centrelink, and one of the things that we were talking about is that how people want to maximize their Centrelink entitlement, but from a cash flow perspective, it's not necessarily what you should be striving for if you're in a position to generate income above and beyond that. But there just seems to be this thing in people's mind where they want to be able to maximize that because they've paid their taxes throughout their working life.
Yeah, and it also means that, if you're in this position and you're not necessarily approaching retirement, you're limiting the amount of money that you can also borrow and leverage, because if you're not generating enough of an income, or if your employment income isn't high enough, well, then the bank isn't going to be able to satisfy the serviceability requirements to actually lend you funds as well. So it can hamper your ability to increase your wealth through debt as well.
Yep. If you're in this position, asset rich, cash flow poor, thinking about it from an income perspective, and you'd be reliant on your personal exertion, on your employment income that you're receiving, in order to make your ends meet. Now, over time, I guess the real simplistic thing that we're trying to achieve in financial planning is taking the income that you generate from a personal exertion point of view and have that get replaced with assets that are deriving investment income for you, and eventually the two cross over and away you go. But in this position, cash flow, asset rich, cash flow poor, you'd be in a position where you're relying on employment income to make ends meet.
Yeah, exactly. Which probably means that if you're so reliant on your employment income, your ability to work and your ability to generate income it's integral to your strategy.
Yeah.
And so making sure that, your income protection insurance, your even permanent disability insurances are so much more important, because you're reliant on that income rather than that income being a portion of your overall income coming into the household. So it does mean that you probably really need to, at least in the short term, make sure that your income protection needs, your permanent disability needs are met for through an insurance policy.
Yep. Andrew, in terms of clients that we talk to who are asset rich, cash flow poor, I guess there's a pretty common theme in terms of what type of assets do they own. I mean, I alluded to it before in terms of what we've experienced in the Australian property market. From my perspective, I guess the first one right off the bat is residential property, where you've gone and purchased a property. Let's say you bought it a while ago. You had the employment income to be able to fund that mortgage. Maybe you've paid it out. That's great, fantastic. All of a sudden, it's gone up in value, but the income that's being derived off that is not a huge amount necessarily, in relation to, say, the yield, if you look at it like that. But definitely residential property from my perspective is one that I see all the time, where people are asset rich, cash flow poor.
Yeah, absolutely. Land as well is another one. I mean, particularly when you start talking about rural properties, there may be a property, whether it's an owner-occupied property or an investment property, but you're talking about a large amount of land that's also that property is sitting on as well. And so if you're not actually doing anything to derive an income from that land, or if you've just got a vacant block that you have intentions of building on or doing something in the future, it's not deriving any income, but from an asset value, it can be very, very significant as well.
Yeah. Yep. The other thing too, not as common, but it could be depending on how a portfolio was set up, is if you've got shares that you own in companies that aren't necessarily paying dividends. So I guess one of the areas that my sort of mind tends to go towards when I'm thinking about this is potentially owning, say, overseas shares.
Yeah.
Talk about the American stock market, where in America, the objective of companies, or the way that companies are run, is different in Australia, where in America, they reinvest all of the spare money that they've got, the profits that they make, back into the business. They're not pushing that necessarily out as dividends to shareholders.
So that's different culture.
Whereas in Australia, it's different. A lot of the companies here are kicking out the income in the form of a dividend.
Yeah. And even private companies. I mean, you're talking about, your maybe mum and dad shops, or your businesses that may not necessarily be kicking out a huge amount of profit. Yeah. But there's a significant asset value in the business. And I guess when you talk to accountants, a lot of accountants will talk about, okay, what's the intention with the business? Is this a cash cow whereby you're deriving an income from that business and pulling out profits all of the time? Or is this you're building an asset that eventually you're going to sell in order to be able to liquidate the asset value, but isn't necessarily providing a huge amount of income? And so you want to have a structure and a strategy as to, if you're self-employed and you've got a business, what are you doing it for, and what's the exit strategy off the back end of it, and how sellable is the business? I mean, if you're the person that's, the face and all of the customers are really drawn to a particular person, what's the sellable value of that actual business?
Yeah, and I guess, look, just sort of pivoting away from this topic for a sec, but one of the things that we see and we're really attuned to is, especially when we're talking to small business owners who think kind of like, okay, my business is my retirement or is my super. And that's great, assuming that you've built a robust enough business that is sellable and you can extract the type of value that it deserves. But if you're in a position where you can't find a buyer, you can't get the price that you want, you're the key person in the business and all of the value is tied up with you. If you exit that business, you can't extract the value that you want. So one of the things that we look at from an advice perspective is, okay, throughout your working career, how can we then generate other assets by maybe taking some of the profit that you're making through your business and diversifying your asset pool just to try and deleverage some of that potential risk down the track.
Yeah.
If in the event that you can't sell your business for what you want to sell it for, at least you're doing something like that to then create some wealth otherwise.
Yeah.
And we see that all of the time. And it's really disheartening as well too if you've got a business owner that's put, a whole career into it and then can't sell it, or they get to a stage where they're exhausted by the business and they practically have to give it away because they can't go on. And they're not extracting the value that they want. So, I just thought that was a relevant point to point out.
Absolutely. Absolutely. We've already touched on the fact that, you can be doing this intentionally. So it's not all bad news. There are people that will get themselves into this position with intention to limit the tax implications. But let's say that you do get yourself into the position where you're asset rich, cash flow poor. What are some of the options?
Some of the options, you could liquidate your assets. I think that's pretty much it from, I guess, the first sort of cab off the rank. That one's a bit more challenging. I mean, for us to turn around and say liquidate assets and away you go, I mean, it takes, depending on what type of asset you're talking about as well too. If it's an asset, and I'm specifically thinking about, say, something like property, because it's so difficult to get into, we see a huge resistance around that for a lot of the time. And some of the things that I talk to people about when we are having this conversation is, it's great, you've got that asset, but if it's not doing its job, and for me, what my definition of doing its job is, deriving a level of income so you can have a certain lifestyle. If it's not achieving that, then let's look at what's the point of the asset, right? So let's look at the alternatives. But from my perspective, if you've got an asset that's not deriving income, sell it. Obviously, it's not as simple because there's tax implications and the like, but sell it and consider investing that into an income deriving asset.
Yeah, absolutely. Absolutely. And talking about selling an asset, I mean, there's also downsizing the family home. So it's a fairly common one. I think that it's one of those things where, at least in my experience, you're either open to the idea or you're not. There kind of isn't that middle ground. And so there are some people that, for them, that's a legitimate option. And for other people, that's just absolutely not an option. It's a hard no. And you can even consider things like, one of the strategies that we're deploying at the moment for a client is, you think about it simply and you say, okay, let's just downsize the family home, and great, fantastic, it works, it's a strategy, and it's pretty easy to implement. But if you can plan ahead enough and you're in a position whereby you can do so, one of the strategies that we're doing at the moment for a client is, they're not planning to downsize the family home for another 10 years. They're working for another 10 years. What's the likelihood that property prices in metropolitan Melbourne between now and in 10 years are going to increase in value? Fairly high if history is anything to go by. And so what we're doing for them is purchasing the downsized family home now, so that you're locking in the floor value of the asset that you're purchasing, allowing, they're still remaining in their owner occupied property. They're going to rent out the family home. They've got the means to be able to facilitate that transaction. And then over the next 10 years, their property value in their owner occupied property will hopefully continue increasing in value. And so where you're buying and selling in that 10-year time frame and deploying that strategy then, because you're doing it 10 years earlier, you've got 10 years additional growth on your owner occupied property that's, $1.5 million. Who knows what that's going to be in 10 years time. Once you downsize, the difference between them is going to be so much larger. And so as a result, you can take advantage of that strategy to an even greater degree. So planning early with all of this is really it's massive.
Yep. You asked me before, what's the options? I think, just as you were talking, I was thinking there's 3, possibly 4 options that I can think of. The first thing is that you liquidate the asset and turn it into something income producing. You look at it and go, okay, I don't want to liquidate assets, so I'm going to stick with the level of income that I do have and just live with it. The third thing is, you were talking about downsizing the family home, but a different play on that is a reverse mortgage. We might come back to that and talk about that in a sec. And the fourth one is potentially get a job.
Yeah.
Or, increase the amount of work that you're doing, side hustles and the like, to be able to increase it like that. So they're the 4 that I can think of. We've got, we don't see this too often because there's not a lot of appetite out there in our experience. But Andrew, reverse mortgages, I mean, I guess it's sort of similar to downsizing the family home, but not. But let's talk through that, because that's also an option as well too that is out there. Probably a little bit more challenging in today's interest rate environment than what it was previously. But let's talk about that, because that could potentially, under the right circumstances, be a viable alternative for somebody.
Yeah, absolutely. So again, another instance that we're going through at the moment with a particular client is they're in receipt of age pension. The age pension income is not sufficient in order to meet all of their lifestyle needs. They've got the property that they're living in, which is their only asset, and they don't have anything else. And so really the options for them are, okay, you're maybe not necessarily asset rich in this particular scenario. I mean, we're not talking about a $5 million property in Toorak or anything, but you're in a position whereby, okay, you need funds in order to supplement your retirement income unless you drastically change your lifestyle. And so for them, the most important, or one of the options, is to take out a reverse mortgage. What that is at the moment, there's 0 debt on the owner-occupied property. The bank will, in essence, lend them an amount of money on their owner-occupied property up to a maximum value, and they will pay them a monthly allowance. So it's basically like a monthly drawdown on a home loan.
Yep.
The debt that's associated with the reverse mortgage is not like debt on your standard residential mortgage where you need to make repayments on it. The repayments that you make and the interest that's associated with it gets capitalized on the loan. So your loan amount actually increases in terms of interest. The reason why a lot of people shy away from this is, one, you're eating into the asset that you're potentially going to be passing on to the next generation or whoever your beneficiaries is. So there's the concern around that. But also the interest rate that you're getting charged is not your normal residential mortgage interest rates. And so you're eating into that equity far sooner as well. But what it does provide you is the ability to draw an income out of an asset that isn't an income producing asset. The real key with this is a lot of people can dive into it, not fully understand the implications, not fully understand when and how much you can draw out so that provides a sufficient income for your lifestyle, completely eat into all of the equity, and all of a sudden the beneficiaries, or they were expecting that their beneficiaries would receive an amount of money at their eventual passing, and they haven't. So for us, the most important step is, okay, maybe this isn't the best financial decision, but are you aware of the implications? Yeah. Do you understand what those implications are, how it's going to impact your beneficiaries, and are you comfortable with that? And if the answer is yes, then absolutely it's a lifestyle decision, not a financial decision.
Yep. I think the other thing just to add with that as well too is if you imagine at a particular point in time where you'd need to do that, assuming that you're older, staying in your family home, put the mathematical numbers aside, you're paying interest on it and what have you, that could be the best decision.
Yeah, from a lifestyle perspective.
From a mental health point of view. Yeah. Not necessarily discounting it as a strategy because it's something that we consider when we're looking at alternative strategies. But from that perspective, knowing what all of the all of the details are around it and what you're foregoing or what you're sacrificing in order to achieve that, just getting clear on what that looks like. And not saying that it's right or wrong, it's just going into it with eyes wide open. But that's obviously, something else that I think is worthwhile to consider, which forms one of those sort of 4 things that I was thinking about in terms of what you can do if you're asset rich and cash flow poor.
Yeah, absolutely. And I think, what we've spoken about and what should be evident in all of this is plan ahead as early as you can.
Yeah.
And not to, look, I'm going to toot our own horn, but I'm not necessarily going to toot 360 Financial's horn so that at least it doesn't come across as a sales means. But have a relationship with a financial advisor. A financial advisor that's worth their salt is not just going to consider, okay, great, this is the best investment option, because it's not as simple as that. It's at what life stage are you at? At what point in time do you want to retire? How much income are you going to need then? How do we position your assets to, one, take advantage of tax implications now, but also with the thought process of, okay, but what's going to happen in the future? What are the capital gains implications of selling?
Yep.
So take you through the life stages of your financial plan, not just accumulate assets because you're accumulating assets and not consider all of the other implications. And there's a lot of information online, and this podcast is a perfect example of that, where there's information, but it doesn't consider your circumstances, it doesn't consider your goals, it doesn't consider your strategy. And so getting information is great, but receiving personalized advice is what's going to make the biggest impact on your financial journey.
Couldn't agree more, Andrew. Couldn't agree more. And taking action, I think, is the biggest thing. We've used the gym and the working out analogy before.
Because Billy's an athlete now.
Because I go to the gym, once every decade and think I'm an athlete. But it's the same thing, right? You can read up all this stuff. You can learn about nutrition. You can watch these fitfluencers online. If you don't go and actually do the work, then nothing happens. So this is great listening to it, but how do you take action? What do you do?
Yeah.
And I guess mimicking and mirroring your sentiment, your thoughts is the value that you can derive out of talking to someone can give you the peace of mind and clarity around the difference between, financial future that's secure versus one that may not necessarily be. So time is your biggest friend when it comes to wealth creation. So I think the earlier that people start looking at receiving advice, I think the better off it is. And hopefully we've communicated that across and some of the value with being asset rich and cash poor in today's podcast.
Absolutely. Bills, thanks again. Hopefully the listeners, viewers have gotten a bit of value out of that. So if you have, like, subscribe, and we'll catch you on the next one.
Thanks, guys.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.